Now, some changes this week at the nation's biggest public pension fund. Calpers has agreed to raise its targets for private equity and venture capital investments. The board raised its asset allocation for alternative investments to 14% from just 10%. Joseph Deere is Chief Investment Officer at Calpers. He joins us now from Sacramento. Joe, thanks for coming on the show. Let me first ask you why you've decided to raise, first of all, your alternative investment allocation to 14%.
We wanted to preserve our option to keep making new investments, as well to assure ourselves we'd have the capacity to meet the capital calls for commitments that we've already made that haven't been called down by our general partners. I think you want to look at this as just a shift within our global equity portfolio. We've added some capacity on the private side by reducing the amount available for publicly traded equities, but it's not as dramatic a shift as it may appear at first glance.
Is it, though, maybe the first step in a larger plan to put more money into alternative assets?
Well, this was an interim step. We wanted to take a look at what had happened to our portfolio in light of the events of 2008. We normally do a full-blown asset liability study every 3 years. That will occur in 2010. We don't want to look at this as kind of a tweak to the portfolio. Preserve our option private equity, raise some cash, put that in the portfolio, and then do a major study next year that might involve larger shifts in portfolio allocation.
It's just very interesting timing because obviously the venture capital industry has been worried about getting good exit strategies. Obviously, IPOs haven't been so popular over the last couple of years. And private equity has been kind of a dead business for the same reason. They don't see really equity strategies that they can put to work. Is that changing, you think? Is that part of the reason for this move?
Well, I think if you're an investor with a long horizon like we are, you got to address this from that long-term perspective. Private equity's in difficulty now. I don't think there's any doubt, and our capital markets assumption assume the ability of private equity to outlearn listed stocks. Short-term, there'll be some dislocation, but going forward, there are. Now, our portfolio is dominated by buyouts, and recent commitments have been in the distressed debt area. Venture capital is very tough. But history tells us that as these capital allocations fall in different parts of private equity, the returns tend to get better. So I wouldn't be wanting to abandon the whole idea of venture capital now. Bottom
line, as far as this decision is concerned, and probably everything, you are fully confident of a total recovery in the markets.
I think one of the most important things we did, Matt, was not changing our long-term assumptions about the risk-return trade-offs. We still think there's an equity risk premium. We think they're going to return, the equity returns in the capital markets line is going to return to its historical state. So after the events of 2008, we really reaffirmed our belief in the long-term capacity of this system to generate the returns we need to assure the pensions that our beneficiaries have earned.
What do you see as far as the short to medium-term signals here for the economy? I mean, what is Calpers' view on green shoots, for example?
I think there's a lot of encouragement about what's happening. There's a return of some confidence, which is extremely critical to moving markets forward. But it's a very fragile situation. Important progress needs to be made on the market reforms that the administration announced. Congress needs to move on those. And investors have to believe that the financial system, the credit system, is returning to normal functioning. If we get that, we'll be okay in the medium term. And in the long term, we're not worried.
How long, though, and when does that happen? Because that's obviously one of the big question marks. You've got all this regulatory change going through Congress now. It looks like it's going to be watered down a lot at the end of it. And you still haven't really deleveraged with the banks. They still have these toxic assets, although they're worth a little bit more, on their balance sheets.
Well, the stress test showed that the banks were going to be able to survive this. The capital raises they made have indicated investor support for that view. Yes, there's a lot of fragility in the system. There's no doubt about that. Calpers' portfolio is $180 billion. We're not going to succeed or fail on short-term tactical moves. We're a long-horizon investor, and we have confidence that we see cycles in the investment markets, but we know if we stick with our plan, we're going to come out okay.
I just have, you've got to have questions about the medium term here. The stress tests only accounted for 10.3% unemployment. It looks like we could hit that before we even go into 2010. Are you concerned about the consumer?
I think the market test was that the banks were able to raise that equity. Am I concerned? Yes. There's a lot of fragility in this system, and we're unusually dependent on public policy coming through to help restore and increase investor confidence. So, sure, things could go a lot worse than they are today. But the progress we've seen in the past 2 months is extremely heartening.
All right. Hey, Joe, I appreciate you joining us. Joseph Deere there, Chief Investment Officer at Calpers.